Sorry, we're having an issue with the video. I might not be able to do that. All right, we can see your screen. It looks like I'm not going to be able to allow your video to be on. I don't know why. I apologize.
Okay, you can, so you can do the video. Okay, well, we will do whatever we have, so we'll go. Thank you again. My name is Doron Neumann, and I work for Key Point Credit Union. I worked there for the last 18 years, and I've been banking for many, many years and do a lot of financial literacy and help people to improve their life through understanding how to manage their money. And I want to see if I can.
It looks
Can
like
you see
your screen stopped sharing.
Okay, let me share again. Okay, can you see it?
Yes.
Okay, wonderful. So we had a session last week. If you're able to join us, last week we talked about. We went over what the financial institutions are, what services they provide, the difference between banks and credit union, and some tips on how to help you to manage your money. Some different products, like what is checking account, what is savings account, and what are the other tools, the debit card and ATM and so forth, the things that involve with managing your money. Today, we're going to talk about a little bit about credit. What is credit score, and how the credit score is derived. Sometimes you hear about something called credit history. So we talk about credit history and also talk about how to establish credit and what are your responsibility and how to look to protect your credit. And once we go over it, we're going to talk a little bit about how to manage your money, what the process, budget, and so forth. So really give you some ideas of like how you can start building a good financial, healthy financial path. If you have any question, you can put them in a Q&A and be able to answer your question. So really, we talked last week. We talked about different accounts that financial institutions provide. Some of them are deposit account where you can put in your money, and other ones are loans. So a loan is an extension of credit to a person or a business, where the person or business can borrow money from the financial institution. And when you borrow money from financial institution, you pay fee, and that fee called interest. We talked about last week that actually interest is a fee that you pay on money borrowed. So a loan is really when a bank or credit union or any financial institution will give you funds, will give you a loan that you have to pay back. You borrow money from the financial institution to buy something. We talk about the different kind of loans, and we go over it in a minute. Interest is a fee paid on borrowed money. So when you deposit money in a bank or credit union, we pay you interest. We pay you a fee to use your money. On the other hand, when you borrow money from us, you pay fee to us because we are the lending. We lend you money and you pay it back as a fee for using the money. And usually, always, this fee represent as interest rate. What is the interest rate? So when you say it's a 2%, 3%, 4%, you can compare between loans and know always what the bank or the credit union will give you, comparing, they're able to compare on one term the interest rate or the rate. So when you have a savings account, the financial institution will pay you the rate, will pay you fee, because you're the one that deposit or lend the money lend the financial institution your money. When you borrow money from the financial institution. In this case, you're the borrower. So you borrow money from the financial institution when you hold a loan account. So there are few terms on loans. So the principal, rate, time period, payment, fixed rate, variable rate, cosigner, payoff, collection, charge-off, repossession, and foreclosure. So I'm going to go over those because I think it's important to understand some of the main terms when we talk about loans. What are loans? So principal is really the amount that you borrow. the initial amount that you borrow. So let's say you want to buy a car and the car costs $30,000. The principal, when you borrow the money, is the principal of the loan is $30,000. This is what you borrow from the financial institution. This is the principal. It's the amount, the original amount that you borrow. When you pay off the loan, you pay it for the term, let's say for 5 years. Then the interest rate that you pay over on the principal. So you have a principal, and then you have the rate. You have what you pay on the principal. So the principal is the base, the initial amount of loan that you take out of a credit union or bank. Rate, again, it's the fee, it's the interest rate. It's the fee that you pay for borrowing money from the financial institution. And you pay above the principal, you will pay interest rate. You pay fee to use this money. Time period is how long you take the loan for. Sometimes you take it for 1 year, 2 years, 3 years, 4 years, 5 years, depend on what it is. If it's a car loan, usually you count it by month. And so it's a car loan, 12 months is 1 year, or you can do 60 months, it's 5 years. So it goes either by years or month. If you borrow money for a mortgage for a home, usually it's about 30 years or 15 years. So time period is the time of the time when you're supposed to pay the loan. And within, if you take a car loan for 5 years or 60 months, meaning that you have to pay off the car loan within 60 months. Every month there's a certain payment. We look at payment. So let's say you bought a car and the car was, just example, $10,000, and you took the loan for $10,000, but your payment also will be, so you divide the $10,000 by like 5 years, 60 payment. And the payment will include your principal, whatever the principal, plus the interest. So it's going to be not just, you can't take just 10,000 divided by 60, and then you find the payment, because also there's actually on it interest. So you have to add the interest to the principal. So the payment is the amount that you pay every month to pay your loan. Fixed rate loan is actually your rate on the loan never changes. So if you take a car loan, an auto loan, let's say example 3% or 4%, the rates for the term of the loan for the 5 years or 60 months does not change. The rate's going to be the same rate the whole time. Variable rate loan can change as the market condition change. If the interest rate in the market goes up, your rates will go up. If the interest in the market goes down, the rates will go down, depending on the economy. So variable is changing. Fixed rate is the same rate the whole time. Variable is changing rates. If they like the economy now, the interest rates are going up, the rates on your loan will go up as the rates on the market will go up. Cosigner is someone that signed with you on the loan. So when you sign the loan, there's a primary signer, meaning that the main person that signed the loan. And if they need someone to co-sign for them to be on the loan, it's called a cosigner. Both parties, the signer and the cosigner, the primary and the cosigner, the joint, are responsible the same way for the loan. So if you take a loan and someone, let's say your parents signed for you, they are responsible to pay off the loan. It's not just signed for you and that's it. They're responsible. If you take a loan and you have, I see it many times, and I'm going to mention it later, take a loan and suddenly you sign it for your girlfriend or your boyfriend, and you are co-signing on the loan, and suddenly you split and you're no longer a boyfriend and girlfriend, you're still both responsible for this auto loan. So if you sign on the documents on a loan, you're responsible for it. Payoff is when you pay off the loan. When you're up to 60 months, let's say you take a car loan for 60 months and you pay every month, you pay it well. The end of the 60th payment, you pay off the loan. Your balance on the loan is zero, I mean, you pay it off. Now your title, it's yours. Collection is when you don't pay the loan and the credit union, the bank needs to start calling you and say, why you don't pay? You need to pay, remind you need to start paying, start collecting on it. So that when you collect on it, collection, there's a fees, there's a late fees. There are a lot of some fees that involve with when you pay off the loan. So I got that question here, and I'm going to answer it when we talk about credit. Let me just go back here. I'm not sure why it doesn't go here. I'm trying to go back. Okay. So collection again. Charge-off is when you don't pay the loan, you decide, oh, I'm not going to pay a loan at all. The credit union and the bank terminate your loan, meaning that you charge off, but then the law does not mean that you should not pay it anymore. Because what happened, we can send it to court, we can get a lawyer, and charge off means that if you don't pay the loan, we can put a judgment in court against you that you didn't pay the loan. So just because the bank decided, oh, I'm not going to collect the money on it, we can collect it through a collection agency and a lawyer and so forth. So it's a lot of repercussion to it if you don't pay your loan. Repossession is when you don't pay the loan and you have a car and the bank or credit union sent a representative to take the car from you. It's called repossession on a car. When you have a house and you don't pay your payment, remember the house, because you get the loan, the house does not belong to you until you pay off the loan. So when you don't pay the loan, you don't pay the loan, and you decided I don't have to, or sometimes there's times that you cannot pay it, the bank or credit union will come and actually will take the home from you. They'll ask you to leave the home, and they will foreclose the home for you. So this is some terms when we talk about loans. Different types of loans. So a secure personal loan is a loan backed by a collateral. So mortgage, home. If you don't pay, we can come and take the home and sell it and recoup our cost for what the money we gave you. An auto loan, a car loan, it's secured by the car. Again, it's against the car. There's a title to it. A mortgage has a deed. A deed is the title for the house. For a car, you have a title, and if you don't pay, you don't pay for it, we will come and take the car from you. When you pay it off the car, you will get a title, meaning now you own it. Now it's your car. Motorcycle loan, it's a secure loan secured by a motorcycle. RV loan, stock secure loans, and certificate of deposit secure loan. And if you have money in a credit union or a bank that it's secured, stays certificate, we talked about what certificate last week, you can secure a loan against your certificate. And you cannot use the money that is in certificate until you until you finish paying the loan. Let me see here for a second. Oh, okay. Oh, sorry. Okay. So those are secure loans. There are also what's called unsecured loan, personal loans. And unsecured personal loan, they're not guaranteed by any home or car. You're the one that guaranteed to pay it off. So student loan, when you take a student loan, you guarantee that once you finish when you finish the school, you will start paying the student loan. If you don't pay it, no one's going to come and take you. However, if you don't pay it, you will take you to court and so forth. So there are repercussions if you don't pay it. So student loan, when you take it, you give your word, I will pay this loan once I'm graduating from school. Personal loan, you take a personal loan, you guarantee yourself that you will pay the loan, and you have to pay it on a monthly basis. Personal line of credit, it's a credit. So let's see what do you think about the type of loan. What is credit card? A credit card is a secure loan or unsecured loan. You can put in the Q&A. What is a credit card? Secure loan or an unsecured loan? Anyone can put it in the Q&A. Can you put the question? Can you put answers in the Q&A? Okay. So a credit card is a secure loan or unsecured. Credit card is an unsecured loan. Unsecured loan is, let's say you get a credit, you don't have the money, right? You use a credit card, you go buy a TV, you don't have this money, you borrow instantly, it's a loan, right? You go to the store, you buy this TV, you take it home, now you have to pay back your credit card. Your credit card is a loan. It's not your money, it's the credit union, the bank money. If you don't pay it, the credit union or the bank will not come and take your TV back. However, you will have to pay. It's not secured by anything that you buy. It's not secured by the food that you buy with the credit card, by anything you buy with the credit card. When you go travel, you can use your credit card. There's nothing secure against it, but it's your personal word say that you will pay this loan once you receive it. Once you pay the debit card balance, once you draw money out of it, you will have to pay it back. So it's an unsecured loan. Credit card is a loan, different than a debit card. Sometimes people get confused. Debit card tied to your checking account. A debit card, if you do not have money in your checking account, you cannot use debit card because there's no money in your checking account. The debit card will not work. On a credit card, actually, it's a loan. Let's say you have a limit of $1,000 on your credit card. You can pay up to $1,000. After this, you won't be able to pay because this is your limit on your credit card. So your loan amount could be $1,000. So now I'm going to talk a little bit about credit. Let's see here. Okay. So this is a great question. Why would someone choose to do a loan with a variable rate? Would you end up paying more than you own? Of course, yeah, it's a great question. So what happened? Credit card is a variable loan. It's a personal loan. There's nothing secure against it, okay? Usually when you have something secure in a general, like I say, a car loan is a fixed rate. But credit card, because it's not a fixed rate, it's not, you can buy today and we'll give you the money. So what happened, the cost of funds for us, the money, costs us more to borrow the money today. So what happened when we give you the money, we have to charge more for you. So usually variable rates are rates that are usually on credit card, on personal loan, but also you can get a line of credit. A line of credit is a variable rate. So a variable rate means that, like, let's say on a house, there's a 15-year variable rate, mean that, or home equity that you borrow against your home, money you already paid and you borrow against the home, because you borrow the money against it, it can be variable. It will be up and down, depend on the economy. So what happened if the economy does well and the rate is very low at the time, then you pay less, right? But again, the disadvantage, if the interest rate goes up, you will have to pay more. So people take advantage of it usually when the rates in the market or the economy are low. And now you see interest rates are going up. So rates on credit cards and home equities, on unsecured loans will start going up because it costs more money for us to borrow and to give you the money. Great question. So this is a disclaimer because I'm going to talk about credit and credit reporting. And so I have to put it, this is for entertainment only, mean that it's for education only. I'm not fixing your credit, anyone that come in, especially if you're over 18. If you have any question about how to fix your credit or any other information about your credit dispute, I can do credit dispute for you, but this is really for education. Just talk about generally about what is credit and how do you create credit. I give you the resources to where to go if you have any questions. So what is credit report? Your credit report is a financial report card with information that determine your ability to repay borrow money and your financial credibility. So the easiest way to explain it, let's say you go apply for university. And the university, 50,000 people apply, 100,000 people apply, but the university doesn't know anything about you. So they need to know, are you a good student? All the information about you. How they will know it? They will go into your report card and they will look at your report card and say, okay, this person has a GPA of 4 or GPA of 4.2, at 3.5, whatever the GPA you have. Now they have ideas to say, okay, what grade did you get? Or they can know if you took an SAT, they know what score you had. So there's a reference for them to go back and say, this is a good student or not a good student. And they can tell exactly, they will admit you or they will not admit you into the university. The same thing for financial report. Financial report actually is the information how you paid your back any money that you took out, you borrow from a bank. So it's used to assess your ability to purchase goods and services and pay them over time. What do you mean? It's that if I give you, let's say I give you right now $100 bill, and I say, you come to me and you say, I would like to borrow $100 from you, and I promise to pay you back in a week. And I said, no problem. I know you. I'll give you $100, and you use the $100, whatever you want to buy. After a week, you come back and give me back my $100. Now I know that you're trustworthy. I gave you money, you pay it back. What happened if you come and say, I need $100? Can I borrow from you? And I say, yeah, no problem. I know you. I give you the $100. And then after a week, you don't pay me back. 2 weeks, you don't pay me back. 3 weeks, you don't pay me back. And then you come back and say, you know what? I'm sorry I couldn't pay you, but can I borrow another $100? The likelihood that I give you another $100 is pretty dismal because you didn't pay me back the first $100. So it's assessing, it's a history about how do you pay back, how responsible you are with money, and how you pay back the money that you borrow. This is the report, the credit report. Is really how do you pay? Do you pay it well? You don't pay it well? How much money you borrow? All this information. So determine your financial trustworthiness. Your personal credit include the record of financial account and obligation, and all your identification information associated with them. So it will give report of all your loans, the terms of the loan, and I'm going to show you in a minute credit report, the term of the loan. You took the loan for 60 months. Who took the loan? Who signed on the loan? If it's you, if there's a cosigner. All your identification, ID information from you, your name, your social security, your address, where you work, all these things are in the credit report. So we know who is the person, because when you go to a bank or financial or credit union and ask for a loan, people don't know anything about you. We have to find some information to make sure that we verify that you're the person that you say you are, and you're the person that be able to pay us back, because we're in the business of lending you money and expecting to get it back with a fee, the interest rate fee. So we know that if you paid back in the past, most likely you pay back in the future. So the report sometimes called credit file or credit history. You're going to hear it again sometime interchangeable, your credit file, your credit history. Credit reporting company, there are a number of companies, I'm going to go into it, collect the data about your credit history from creditor, from the banks and credit union, and also from public records. So from your birth certificate, from your social security, from all this information that is public, it's collected information, ID information about you, and put a profile on you saying, this person, this is the date of birth, this is where they live, this is where they work, this is their social security, this is their full name, and they took a loan from Keep On Credit Union and they paid back, or they took a loan, they didn't pay it back. All this information is collected by credit reporting companies. Credit report is a record of a debt paying history. If you had a car loan, student loan, any credit card, department store credit card, any loan that you take, anytime you borrow money, it will be on the credit report. It will be reported. It includes how much money you borrow, who you borrow from, what the time frame that you borrow for, how timely your payments were, how much credit available for you. So let's say your credit card. Right now you get a credit card with the limit of $1,000, right? So it will say your limit is $1,000, right? If you spend $200 at the end of the month, you still have a credit of $800. But you show that on a credit report that your balance is $200, but you have a credit for $800. But you did not go over the $1,000 credit limit that you were given. So what happened when you have all this? There's a formula, and I'm going to in a minute, that calculate all this information. And if you pay well, your loan you pay well, it score you. So it's called a credit score. There are a number of companies that are in the US that are collecting this information about individual and businesses. But I'm just going to talk about individuals. They collect the information and they share this information, they sell it, they share this information with companies like licensed companies, like credit card companies, banks, credit unions, and anyone that provide loans. They will share this information, they will sell this information to. There are three major credit bureaus. Bureaus are credit companies, and one of them called Experian, Equifax, and TransUnion. Those are the major credit bureau, credit companies in the US. They collect the information and they share it with the financial institution. Let me see a question here. So those companies will share the information, and they collect it and share the information. Okay. So here how it works. So once you take a loan, you will take a loan. Let's say you take a loan here. You will pay the lender, the credit union or the bank, you pay monthly payment. Once you pay the monthly payment, let's say you took a car loan for 5 years and your payment is $300 a month. Just give example. So you pay on a monthly basis, you pay on, there's a due date, meaning that the day that the payment has to get, let's say your due date is the 5th of the month. On the 5th of the month, the payment has to be in your account, pay for the loan account. Once it's paid, the lender, the credit union banks will update your record, within their information in the bank or the credit union. They update your information, say that, oh, you paid well on the 5th. They will take this information, I'm not sure where it's, and share it with the credit reporting companies. We'll send it to the credit reporting companies, so the Equifax, TransUnion, and they will send it to them. And once they send it, these companies will take all the information and put it in your file. It's your file. Think about it as a library that every person has a book, and this book, all the record of that person is written. So the company, the credit company, will put the information, will generate a score for you based upon how well you paid and what is your balance and so forth. There's an equation, I'm going to go into it in a minute. And what happened, once a new company, let's say you go back, now you're going and you want a credit card, you go apply to a credit card, the bank or the credit union will put the credit application here, and they will get the credit reporting. They ask the credit reporting to send the information about you, see how you paid, and that's going to be your record. They ask your record to know if can you lend more money to that person. So this is the cycle of the credit cycle. Credit score, the different range of credit score, different companies, different bureaus or credit bureaus using different formulas. FICO, it's the first company that started with a credit score. It's actually, it's called Fair Isaac Company. It's the person that came up with the credit score, and it's ranged between 300 and 850. It's the range of the credit score, the grade. So like you have, like in school, you have A, B, C, D, E, F. And a credit score, you have from 850 to 300. Vintage score is another model that it's gone between 990 to 500. There's a transcript from TransUnion that run between 900 and 100, and Equifax will have 850 to 280. Those are the ranges, meaning that the highest is the best score, the lowest on the range is not the great credit. This is the best credit, it's not great credit. Most credit score include FICO score and the version of it. So there's different version, but every company again will have a different version. But I'll show you what the version, what actually it's includes. Excellent credit, when you have excellent credit, the general idea, excellent credit is run between 850 and 781 or so. This is usually on a FICO, on this scale here, on this company. Good credit, I mean, that means that you paid, but maybe you missed one time, or you don't have enough credit history, you don't have enough time in a credit bureau. It'd be between 661 to 780. Fair credit, 601 to 660. Poor credit, not great credit, is 500 to 600, and very bad credit is below 500. So this will show you a little bit what happened when you have good credit score. So when you have great credit score, usually you can qualify almost for any loan. When you go to apply for a loan, you can almost qualify for any loan. Now, a disclaimer, if you just started, you just had a credit card and you're going to apply for a home, you probably not qualify if your only credit was that extended to you was $2,000 and now you're going to apply for $1 million home, it's not going to happen because there are other factors that apply for it. However, what it tells the bank or the credit union that you are responsible, you're paying your loans that you have so far well, and so the higher the interest, the higher the score, the better your credit. Also, when your credit is, you have a good credit, you qualify for the best interest rate, mean lower fee. And the reason for it, because the bank or credit union know that this person is responsible and they will pay your loan well. So mean that you wouldn't have to spend money on collection, they wouldn't have to spend money on following with the person, make sure that they pay, or the risk is less. So it's all about the risk. What is the risk? We know that there's a less risk that they don't want to pay, that they're going to pay, mean that we'll give them good interest rate. But if the risk that, let's say, someone that has average credit, mean that maybe in the past they did not pay their loans, then your rate's going to be much higher. So you will hear through the years that said that your interest rate based upon your credit score and your credit history. So when you have good credit, you always pay less, and it's true because your interest, your fees that will pay will be much less. When you don't have great credit, you will have to pay much more because the interest that the bank or credit union would charge you will be much higher. There's more risk to lend you money. I think I have a question here. How continue to start building a credit history? Great question. I'm going to go to it in a few minutes. So how do credit score determine? So there's a formula for it. And again, it's a secretive formula that each company has. But what we know is the component that really make the credit score. So let's give you an example. When you go to school, a teacher tells you that you will get A in the class if you get A in all your quizzes, A in all your homework assignment and final project. So the different components that come together to get the final grade. The same thing for credit score, the different components. And so that's 30% of really what determine the credit score is the amount you owe. How much money do you owe? I mean, how much money extended to you by the credit union or the bank? Let's say you have $1,000 limit or you have a loan for $100,000. If someone has $100,000, means that the bank or credit union gave them much more money. They trust them to pay back. So it's really depend upon how much you pay. Payment history is the most important. What do you mean that did you pay on time? Were you late? Or, were you pay on time? And it's one of the most important. You always want to make sure that you pay on time. And if you don't pay on time, you're late, it will show on your credit report and it will lower your credit score. So always pay on time. Length of credit history, how long you have it. Someone that has a credit history only for a year wouldn't have the same score. Someone has a credit history for 3 to 5 to 10 years to 20 years. Then they pay well. So the credit history, the length of it is also going to the formula. Type of credit use. So what is the mix of loans? Do you have a mortgage? Do you have an auto loan? Do you have a credit card? Do you have a personal loan? What kind of mix of loans do banks or credit union willing to lend you money for? So this mix will be about 10% of the score. And new credit, what was the last time that you asked for credit? Was it very recently or was a long time ago? When was the last time the actually credit union or bank or financial institution grant you a loan? So all these items are going to the formula and calculate your credit score. So this is how credit score is calculated. Now, a credit score, this is a sample of credit report. Once a year, so you have to be 18 years old to have a credit report. You're not going to have any information under 18 years old. You're not legally able to sign a contract under 18. So credit card loans and so forth are legally binding contracts. So let's say someone told me, well, but I'm on my credit card, I'm a signer on a credit card for my parents. Well, you're not on the loan. Your parents put you as a authorized user. You can use the credit, but you're not on a credit card. It's not your own personal credit card, even though maybe you have your name on it. It's not your personal credit card. Legally, you cannot get a loan until you're 18 years old. When you're 18, you can sign a legal document, and this is what a loan is: a legal document saying that the bank or credit union will give you funds and you will pay them back. So you don't really have any information in your credit bureau before you're 18. Once you start putting a credit, when you start putting an application, a credit application in, you complete your application, it will start to populate your credit score. You will have some information on it. So the credit score will give you your address. It will put what address you are at, your social security, and it will put together, what kind of what account you have. I know it's a little bit small, maybe you see it, but what account number, what address of the bank that you have, or credit union. It's individual, it's two people, what the balance is. So it's to give you all the information and account history. Did you pay well or you did not pay well? Were you late or not late? So it will give you all this information here about your account, your credit file. It will give you your information here, all the information about you on the report, your social security, and everything. It's just a sample from experience. And this is give you a sample like, there's no public record. If you have a public record, if you have a lien against you, didn't pay taxes, or any public record against you, it will appear in a credit report. And let's say this one has a credit card with 1, 2, 3 credit card example. We give you the account number, what is the balance, and here we give you how you pay. It's a green means that you paid okay. Yellow means that you missed payment by one time, you missed it by 30 days. So this is really definitely affect the credit score of that person. This is one, they pay all the way. You see, okay. I mean, they pay well. You give all the account information that you have. And again, this every account, all the information, and this is a sample of credit report. And there are a lot of disclaimers and so information explaining the credit report. So it's very important when you apply for a loan, when you get a loan, you take a loan out and you apply for first time a loan, you need to make sure that you put the right information in your application. Don't do it rush. Some people, I can give you an example. Some people go to some department store and someone stay there and say, hey, I give you 15% off. Put the credit application with me right now and we can give you 15% off. So people do it. And what happened, the person that input the information for you, they have no idea what interest rate you pay. They have no idea about any information about the credit. They just want to sell you a credit card so you can get the 15%. You happy get the 50%. They may put your social security wrong. They put your address wrong. And this will ruin your credit from the start. Every time you take a loan, you need to take your time. You need to understand what are you taking. You need to complete your application, make sure that everything is correct. You don't want to even have one letter misspelled in your name because this will flag as a fraud. So you need to make sure that everything is spelled correctly, all the information is correctly and true. So make sure that you don't lie on the credit report. You put, oh, no, I make right now work for, I don't know, let's say you work for the summer and you make $1,000 for a month. You put, I make $40,000 a month. Or, I mean, you make sure that you put the right information because anything that you put in will be checked. It will be actually, when you put it in, first of all, the financial institution will ask to check it. Second, it will flag as fraud. So you need to make sure everything is correct. So if you don't take a lot of stuff from today, make sure you take that every time you apply for a loan or credit card, any loan, anything you do, you check what you put in. You check on, because even one letter misspelled on your address, you're not going to get the statement and you're going to have a problem if you don't pay your credit card on time. So you need to make sure that it's always spelled correctly and all the information is correct because you're going to have to sign for it. So why good credit matter? One is, if you don't have good credit, it will affect your life. You won't be able to get housing. You won't be able to get transportation. You won't be able to buy a car, right? Because you may be able to buy a car for cash, but later you may not be able to buy it. So you have to borrow maybe money to get some money to buy to get a car. You have to get the auto loan. Employment. Some companies check your credit. If you work for a financial institution or any institution that deal with sensitive information, financial information, or cash, will check your credit. Utility services. If you want to get utility hooked to your apartment, they will check your credit, make sure that you paid well. If you get the cell phone, they will check your credit, make sure that you pay well. They won't just give you an account, they will make sure. Insurance, car insurance will check your credit. If you don't have a great credit, your credit rate usually is much higher on your insurance. And entrepreneurship, if you want to start a business and you like to take a loan for a business and long term, you will need to make sure that you have a good credit, because when you start a business, the business has no record, so all the credit will be depend upon you. So those are some of the reasons that you really want to make sure that you have good credit. Let me question here. So one question: how can a teen build their credit history? So what happened? There are different loans, different ways of doing it. Different banks and credit unions offer different products to start credit. The different credit starter programs. So you will have to do. I don't want to be biased. I want to make sure that you have to make your own choice. I don't know if your parents going at banking in some place or the bank or credit union, but you need to make your research. You need to look at all the companies that they have a credit starter programs and look at there and see what those companies offer, and you have to compare it. And some credit, some people will ask you for a cosigner, some people will ask you for no cosigner. It really depends. So you need to look at it. Again, banks and credit unions do have programs for people that's just starting the credit, and some of them are credit starter programs, some of them are called different ways, but you just want to look at it and say, okay, this is maybe the right program for me. Usually the program that's going to be secure, some of them going to be secure fund, where you're going to have to put $500 as secure, that you have to borrow against it to build the credit. The big thing is when you take a loan, no one's going to give you, if you have no credit, no one's going to give you a car loan for $30,000. Unless you have a very strong cosigner, someone that already have established credit to be on your application, and they will guarantee you, then you may get a loan. So there's some ways of, like, if you go, let's say, on a parent cosign for you, and you start having a credit card, you take a payment, you make a payment every month and stuff that you charge, it will record in the credit history, you record in the credit bureau. But you will have to put an application first and make sure that the application is correct, all the information is correct. So the different ways, it can be a cosigner, you can be a credit starter program, there can be different ways to starting it. You can be a secure loan, you have to put money in a certificate and take money against it. They're different. So I will recommend for you you can look at different banks and credit union, the website, look at what credit starter programs they have and what they offer for people with new credit. There's some videos about it. There's some we have videos about it. Some other institutions have videos about how to start a credit and so forth. So it gives you some idea, and you have to make your own decision. If you're not sure, I will say, no, go to your bank or credit union and ask people. Go to the branch and say, I'm just starting. What do you have for me to start a credit? And you take the information, look at it, you make sure that you understand what it is before you really make a decision. If you don't understand, you make sure that you take it to your parents, you get an adult that look at it, and really help you make a good decision. Because what happened, it's the first step for you to start your financial journey. And it's very important you start it the right way. You don't want to start it the wrong way. You don't want to go to a department store and get a credit card and say, I have a credit card now, while there's an error, there's a mistake on the way you put your social security, spell your name, and later it's going to create a lot of issue for you when it won't record the right way for you, that you're the one that took the credit card, and it may be flagged as fraud. So you need to make sure you be very careful. If you have any question, again, I'm sure that any credit union or bank be happy to help you, or your parents, or guardian, or anyone else. You know, if you go to our branches, people will be able to help you. Anyone be able to really give you some advice. You take all this stuff and you make the right decision, and advice, like you say, your parents or so forth, or your banker or someone in the credit union. Where do you pay your credit? So if you take a loan, you pay it back. So if you take, let's give example, if you take a loan from Keep On Credit Union, you pay it back to Keep On Credit Union. You pay it back to the company that gave you the loan. Okay, so most people today, if you take, let's say, excuse me, if you take a loan or credit card with Key Point, you will have to, you set up a online banking, you set up it automatic payment, which is the best way to do it, just to make sure that you have money in your checking account. What happened, you set up an automatic payment, so every month on the due date, it will automatically go into your loan account. So you go from a checking account to a loan account, or you can pay it manually. You can just transfer money. Different bank credit union have different methods how to do it, but the best way to do it is to set up it's called automatic payment, where it goes from your saving or checking account, automatic payment into your loan, and it's paid directly to the loan. And if it's automatic payment on the day of the payment is due, it will pay to the loan. So it's the best way to go about it. Then you don't forget about it. It's right, always on time. And you know that you paid on time and you're establishing your credit. It takes time to establish credit, not because you have a loan and after 2 months you think you already have an 850 credit. It won't happen because you don't have credit yet. It will take time to build credit, but it takes time. As long as you pay it well and you do smart, make smart decisions, you'll be able to establish your credit. So the resources, every year you can get a free credit report from one of these agencies. I will say, do not buy those. You can get the free. You can go into those website and just Google free, just search free credit report. If you don't have anything in the credit report, you wouldn't get anything. If you have something, you will get something for them, but you get free. Once a year, you get free report. And it's very important to check your report all the time, because what happens if there's identity theft and someone steal your identity, they can get a loan on your name. And guess what happened? You be responsible for this loan. So if someone steal your information and apply for loan for you and take a loan and don't pay it, guess who's responsible? You're responsible. So always want to make sure you check your credit. There are different services, online banking services or mobile banking services when you can log in, and actually we offer, and other credit union and bank offer, it's free to monitor your credit. They can monitor your credit, and you see your credit score goes up and down, or if there's alert and stuff, it will give you alert if something new happened to your credit. So you can do it. A lot of banks and credit union offer this within their mobile banking, online banking. It's a credit score module, and you can do it. But those companies will send you a report once a year. And also there's a lot of great information. If you go to Equifax, Experience, or TransUnion, there's a lot of great information about credit you can read. I will encourage you to learn and read, because this will help you for your future. So again, how do I build good credit? I understand what credit is. Before you start, you want to make sure you understand what it is. This is what I give you today is really the basic, but you want to read about it, go to to this agency, to the bureaus, and start reading about it, see what is credit. Look, watch videos, a lot of information out there to see what is credit. Do not sign anything unless you understand what you're signing for. Be responsible. Make sure you can pay it back. Don't buy something if you cannot pay it back. Don't charge on your credit card if you cannot pay it back. It's a loan. If you don't pay it back, you can ruin your credit for a long time. Charge only what you can afford to pay. Pay all your loan and bills, credit card bills on time, always on time. Set up automatic payment. It's the easiest way. Avoid going over your credit limit on your credit card account. If your limit is $1,000, you don't want to charge $2,000. You stay within your limit. Know which account are shown in your credit report. You want to get your credit report to see what account are there. Request of credit report at least once a year to review it and check that the information shown in your credit report is accurate, including your information, your name, your address, your social security, everything needs to be accurate. If it's not accurate, you can work with those credit bureaus to correct it. There are different ways you can work with them to fix it and create a budget. So from here, I'm going to go to a budget. So once we understand credit, we talk about what are the deposit accounts, like saving, checking, how you can save, how you manage your money to a checking account, what are loans, how you take loans, what is a credit score. Let's talk about budget. Budget is really very simple. Budget is a plan. It's a budget is estimate of expected income and expenses over time. So let's give you an example. Within 1 month, how much income, how much money I make, and how much money I spend. Budget is a plan of how much money coming in, how much money going out. It's a written plan. It's a very, very simple thing. Budget is a written plan. And you create a budget, you need to know how much you make every month. Now you need to know how much you make every month, how much you make if you have investment that you get in, if you go to get a job, how much you make in. You make out of what are your earnings? Now, when you get a job, let's say you say, well, I get paid $2,000 a month, but out of the 2,000, they actually their taxes, their benefit maybe, their social security that is taken down, and all other deductions. So you may just bring net. This is what the gross overall what you make, but the net is what you actually get into your checking account. You check that you get is the net, what ended after all the deduction, all the benefits and taxes. So you may ended up with only 1,500 after the 2,500 goes toward taxes or security benefit. Maybe you maybe end up with only 1,500. So this is what your income is. Expenses is what's going out, your bills, all your eating out, your entertainment, your hobbies, your rent, all these things that you have to pay out. Those are your expenses. So it's very simple to build. You can do it on a napkin. I will recommend to do it on Excel spreadsheet. It's very simple. You can Google a budget, and this is example of a budget. So you see net income, I said it's like what I get in the bank. That's a 3,500 bonus. I got bonus, no other income. I don't have nothing. So my total income, money coming in is 3,500. And expenses or debit, what's going out? So rent I pay, let's say 1,800, car payment 350, car insurance 200, utility cell phone 250, food 600, clothing 100, savings 300, entertainment 200. Can someone tell me, can put in Q&A, what is my total expenses for the month? Can someone just calculate and let me know what my total expenses for the month? Okay, so let's see if someone said 38. Okay, so 38, 3,800. Yes, so 3,800, right? So total expenses, I calculate everything at 3,800. Thank you. So 3,800. Now there's a problem here because my expenses are 3,800, my income is 3,500. So what happened? I look at what the difference, the income less the total expenses. My expense is 38 and my income is 35. Now I'm a negative 300. I mean, I have more expenses than I have income. It's a problem. So what do you think I should do? What should I do? What do you think should I do with it? Now I have more expenses than income. What do you think? If someone could put it on a Q&A or chat, what do you think I should do with it? Okay, get rid of entertainment, Sarah said. Okay, excellent. Get rid of entertainment. Spend less on clothing. Excellent. So let's see what we do. So Exactly. So my income is 35, didn't change. I can get a job, or I can get another part-time job and have more income, right? And then increase my income. Or rent, probably rent is fixed. I can change it. If I need to move someplace else, it will cost me money. Car payment is the same car payment. It's a fixed car payment. It doesn't fluctuate. Car insurance is usually the same. Utility, cell phone is usually the same. You can maybe use less electricity. If you have AC, so forth, it's the same. Food, maybe I decrease on food a little bit. I don't have to buy clothing that month, right? Maybe I don't have to go to movies and do entertainment this month. I always want to keep saving in. Saving is very, very important. I always want to make sure I can save. So now my expenses are 35,250 and my income is 3,500. So the difference is 250. Now I have 250 that after I make changes, I left with 250. Now, when I'm saying you're cutting food, doesn't mean you have to starve yourself, okay? So it doesn't mean that you don't have to eat. You want to make sure you eat, but maybe you look at things that are like clothing that you don't need to buy every month, or entertainment you have to get every week to a movie. So now, what do you think? What should I do with the $250 that left for me? Put it in your chat or Q&A. What should I do with the $250 that left? Excellent. Add to saving. Very good. The money, the big thing is that you want to save. You always want to save. So any extra money, you want to make sure that you save. So in addition with your budget you have saving, you want to make sure that anything that left, you want to save. You always want to save. We talked about savings before last week, why savings are important. Make sure that there's an emergency or need money, you always have money saving. So the budget really is about managing your money and also finding ways to save and put money aside. So I go needs versus wants. When you talk about budget, talk about needs versus wants. So the things that we need and things we want. If I go and I see a new item that I really, really want, I want a new iPhone, but I know that it does not fit my budget, do I really need it? So my suggestion to you, that a lot of people fell in budget when because of impulsive spending. People are sitting and say, oh, well, I'm going to buy it now, but they know they may not have money to pay for it. So you want to make sure that you look and say, okay, do I really need it? Do I really want it? If I wanted to, can I pay for it? So it's very important when you do a budget, when you spend, you need to say, okay, do I really want it or do I really need it? If I need it, it's great. If I want it, it's great too. But can I afford it? If I cannot afford it, then maybe I shouldn't spend money on it. Budget. Once you create a budget and you cover your monthly expenses, your financial goals, you want to make a goal. You have a goal. You say, well, every month I want to save $100 for my, in addition to the $300 I save, I want an extra $100 to put in my saving. This is your goal. So you kind of work your budget. Your budget is a living thing. You can always move it. It's not fixed. That's it, the budget. I can move it. You know, if you set a budget and you see that it's not enough for food, well, food is a need. It's not a want, right? So you can you spend more money on food. Doesn't mean that you have to go eat out every day in an expensive restaurant, but you need to make sure that you not starve yourself. It's not about torturing and starving yourself. It's about really finding a way how to control your spending based upon your income. And of course, you always want to make sure, okay, if I don't make enough money, maybe you want to, maybe you want to get another degree and make more money. Maybe you want to work toward promotion at work. Maybe you get another job. Maybe you open a business. There are different ways to start getting more money, but also always want to make sure that you learn, you have a plan how to control your spending, where you're spending, where's money going, and actually how much you spend. It's good to know how much you spend and how much you have. So it really give you some good idea of how to manage your money. So budget is very important. It's not complicated. You can put it, as I say, on you can pull a spreadsheet and put it, and you can start it even now. Maybe you have some allowance or you have money coming in, you do a part-time job, you put how much money you have and how much money you spend and see how much money you're able to put in your savings. So frugal frugal budget is never finished. Continue to look over your budget every month, look to make sure you're not overspending, crunch the numbers. Sometimes we spend a lot of time on social media, but we don't put time to spend on our budget. So you want to make sure you put some time to spend your budget and understanding your financial, maybe not spending 10 hours or 8 hours or 7 hours or whatever it is on social media, but paying more attention to your budget and where your goals, financial goals. Be honest with yourself. Be honest about your spending habit. Be realistic about budget. You have to be realistic. You can't be starve yourself. You have to be realistic about it. Budget is fun. Budget is not about deprivation. It's about a tool that helps you to manage your money. And don't be afraid to change your budget. A good budget is always evolving. Always evolve a good budget. So this is a little bit about budget. Now we're going to really all come together to the personal balance sheet. Personal balance sheets provide you overall snapshot of your wealth, right? And through time, you want to accumulate wealth. You want to grow your wealth. Maybe now you don't have much, but you want to make sure maybe your goal is to be very rich one day. So how do you work it? You say, well, I'm going to do it when I have money. Well, if you don't know how to do it when you don't have much money, you don't know how to do it when you have a lot of money, okay? The same thing for budget. Don't wait until you have a lot of money, say, now I'm going to do a budget. You have the tools now, you learn about some tools that you can actually work and find how to manage my money and how to really build good habits and use good tools to manage my money and build my wealth. So a personal balance sheet is a summary of assets of what you own, what's yours, and liability, what you owe someone. Or like every time you take a loan, you owe someone. And what is your net worth? How much you're worth? Asset, it's asset minus liabilities, how much you're actually worth. So it's very simple. Is this asset liability? If you can write $1,000 in your saving account, is an asset or liability? Put it in your chat. Money in your saving account is an asset or liability? Let's see. Asset, very good. It is an asset, right? It's yours. You own it. It's an asset. In your saving accounts, it's an asset. $200 balance on your credit card is an asset or liability? What is money that you own your credit card? Asset or liability? Put it in chat. Liability, very good. Liability, so liability there. Yeah, liability. So you own someone, great. So if it's your money, it's your asset. It's someone you owe someone is liability. So this is a simple personal balance sheet. Again, all these tools are very simple. You can create it on a spreadsheet. You can create your own spreadsheet, create your own balance spreadsheet, your own budget spreadsheet, and your own personal balance. So I'll give you an example. Let's say you have a checking account, you have $300. Your saving account, you have $1,500. Your investment account, maybe you have $1,500. You own a bicycle and the bicycle worth $200. Now I wouldn't put the bicycle you bought it a year ago for $800 or for $400, and you think they're worth the same. If they use, the value go down. But let's say you can sell them for $200. So I calculate what is my total asset. My total asset is $300, right? At $3,000. This is what I have right now. Okay. Let's say I have a credit card that I owe $550 and personal loan that I own $1,000. So now my liability I owe $1,550. So in order to know how much really I'm worth, what is my net worth, I do total asset minus total liability equal net worth of $1,450. So today you maybe own $1,450. Through time, you will see what happened is that this will, as you're growing up, you can start work, you get your business, so you're going to see this growing more and more. You invest for the future, to your retirement account, to savings account, you manage your money well, you have a car now, you have other assets, your assets growing. But also liability may grow too. You may have good liability, like you buy a home. So you own, like, let's say $800,000 on your home, and your network going to be negative. However, you have good investment, you bought a home. To a time when you pay this home, this will mean you're going to be another column here, say how much you have equity in the home, it will grow. So over time, you see that this will grow. Our goal is really to make sure that your network is growing. Okay, this is what you're working. So it's very simple. It's a tool that tied to your budget, because the more you manage your budget, you know how much money assets you accumulate and how much liability you have, how much your payment you have to do on a monthly basis, so you know what is your total liability. And then you find out what is your network, how much you're worth, what is your wealth. Some money management tips. Let me see the question here. Okay. And this one is, okay, we answered this already. So some money management tips. Be a lifelong student of personal finance. Study saving and investment. There's so much information out there. I will say read all the time about it, because some people never read about personal finance. They started making money, they don't know how to save, how to manage their money. Don't wait, start it now. You understand, because it will really affect a lot. What you do is understanding how to manage your personal finance. It's make it a part of who you are. And I think it's very important to understand how money works, how budget works, how financial, all your personal finance work. I think it's very, very important. Set up SMART goals. We didn't talk about it, but SMART goals are specific, measurable, time-bound, realistic, and action-bound goals. You can look at the SMART goals, make sure you have a long-term, a short-term, and realistic goals that you can actually manage. Create a personal balance sheet. Create a budget, work on a budget. Even now, you do a budget. Even you just maybe have $100 a month that you bring in, but you spend maybe $10 and you put $90 into saving. It's good. Create your own budget. It's a habit. I look at my budget on a weekly basis. I look at my personal balance sheet probably month to month, but it's something that I always look at. It's the same thing that I look at my checking account every day to make sure that I don't have transaction that I'm not familiar with. It takes me 5 minutes to look at it. So this is very important to make it part of your life. And if you make it, you have a great start for your successful financial journey. Start saving habit. Set money aside for future now. Don't wait. Start a lifetime of healthy saving habits, and always pay yourself first. Always pay yourself first. And that you pay yourself first is you put money into savings. Make sure that you have money in the saving, because it will make your life much easier. Be a smart shopper. Needs versus wants. Avoid impulsive shopping, because just because you need it right and want it right now doesn't mean that you need it right now, and it may cost you later. So make sure that you always make sure that it's the right thing. Consult with a qualified professional. Invest on investment and other key financial matter. Look at the professional. Make sure that they're licensed, they understand what they're talking about, they know before you make decisions. There are a lot of information out there on the internet, on YouTube and so forth. People making $2 million in 2 days and so forth. Don't take things for granted. Make sure that you look at this. Okay, does it make sense? Make sure you make the right decision. Use common sense when you look at these things. And go, again, the banks, the credit unions, you can go and talk with people and ask their opinion. Do not sign anything that you don't understand. Do not sign any contract, anything you don't understand, because once you sign it, you're responsible for it. Make sure you're very careful. You understand what you're signing for, and when the information you put is the right information. And again, we've seen people signing for other people and say, oh, I'm just second on the loan, I'm not responsible. And they're responsible for the loan. So suddenly they find themselves owing $10,000 because the person that took the loan and the co-sign for it cannot pay it. So you need to make sure that you do responsibly understand what you're signing for. Be responsible and use common sense. And this is all I have for today. This is just really the basic, and I hope you get something out of it. Again, I say, if you don't understand, read about it, ask, learn, find ways to do it. get the information, have good budget, and start reading about your personal finance and establishing. If you establish good habits now, it will last for a long time and lifetime, and you will have a great, successful financial journey. Just by attending this session, you already, I applaud you, because you're already starting understanding and trying to learn how to really establish yourself a great, successful financial path in life. Let's ask a question here. Thank you so much. Well, thank you so much again. And if you have any other questions, please don't hesitate. I know we're raffling 2 Amazon 25 gift cards for among the attendees of today's webinar. So I know this will hand it to the library, and we will help the library to distribute those cards to you guys. Again,
Yes,
thank you very much.
Sorry.
Thank you very much.
You.
Yeah.
Thank
Anything
you so
else?
much for your presentation. And just so everybody knows, Shell will contact the winners for the Amazon cards.
Yeah. Great. Well, thank you so much, and I really appreciate your time, and again, good luck to you.
Thank you so much.
Thank you.
Does anybody have any questions? No. Okay.
No. Okay. Well, thank you much, and I really appreciate the library and so forth. The library is a great source. If you guys look at the library, is a great source to find a lot of information about financial information. So thank you much, and good luck.
Yes, thank you, and have